Thank you very much. So see, it's a hardcore crowd that still came out despite the storm, so that's pretty impressive. So again, my name is Anton Mattli, co-founder and CEO of Peak Financing. We are a commercial real estate debt brokerage firm. This strange accent is not from Texas, even though I have been living now in Dallas for 17 years. I was born in Switzerland. After graduation, I moved into banking. So I'm one of those that worked in investment banking, these hated banks. I didn't work for Credit Suisse, but I worked for UBS. That is the main competitor. And we went through a couple of turmoils with them in the 90s when we had one of the first major issues with credit derivatives. It was long-term credit management back then that was lost a significant amount of money, which is by today's standards is absolutely peanuts. Now we talk about not just a few hundred million. Now we do not just talk about a billion. Now we talk about tens and hundreds of billions that are needed for a bank to lose money before anyone is even concerned. And when then a bank is apparently in deep trouble, then the whole market is concerned. So let's see here. Do I just go here? All right, so let's look back a little bit in history. Everyone is freaking out, obviously, about this part here, right? With the Fed fund rate having moved up significantly, very quickly, but by historical standards, excluding the period from the Great Recession forward, was not really at that low level. So everyone got used to record low interest rates, and now everyone is freaking out, as usual. Now, when we look at the more recent period, as I mentioned, we had the Great Recession, and the Fed fund target limit was essentially at zero. It was 0.25%. Now, then in the 2016, the Fed realized, I think we are starting to overheat, so let's raise the rates a little bit. And we already had a little bit of turmoil in the real estate market. Some of you who were already active back then, you may remember that it was already a little bit problematic from a financing perspective. And this part here, as you know, COVID happened in March of 2020, and Fed fund rate came down again, and all the other rates came down. And at the same time, we had trillions and trillions around the world that were injected into the economy. Unfortunately, now we have this year. And the reason for that really is that they waited way too long to raise the rates while they injected all that money. Now, none of us are financing with Fed fund rates. We are financing typically short-term based on LIBOR. That was the original standard, and now it's SOFR, secured overnight financing rate. And matching the Fed fund rate, SOFR was essentially zero for a very long period of time after we had the start of COVID, and it matched the Fed fund rate, and we essentially were at zero for a very long time. So we were at zero to the early part of 2022, and all of you who were active in real estate at that point, you remember how everyone was freaking out once the Fed raised rates, and naturally the SOFR matched it and moved up too. What about the 10-year Treasury, right? Right now we are just below 4%, around 3.5%. and everyone is complaining that the 10-year treasury is very high, right? Again, by historical standards, it's not. It's just that we got used to that low rate environment. Now, when we look at, again, just from 2020 to 2023, we have had that situation where we had COVID hitting, and the 10-year treasury yield at some point was slightly below 0.5%. And now then we moved up to above 4%. And we had a fluctuation in between depending on where inflation came in and how the market anticipated that. Now we have had that dip, right? Why did we have that dip? Whenever the market freaks out, there is a rush to treasuries, and that's why the treasury yield came down. You don't have to mention the name, it's SVB, which stands for the tech people in California. Now, as I mentioned, right, in the past, 500 million of a liquidity crisis was a lot of money. Then it was 1 billion. And now we talk about a bank that has assets of around 200 billion, and you have a bank run for almost 50 billion. It's unbelievable the numbers we are talking about in today's environment. So, as I mentioned, SOFR was essentially at zero. During that period here, we were at around 0.01, 0.05, and the spreads were extremely good. The spreads over SOFR for a typical bridge loan, a large balance bridge loan, were just around 300 basis points. So you were able to borrow at around starting rate at 3%. Lenders loved that. They were willing to provide maximum leverage, 80% LTC. At the same time, the same lenders or a partner or a third party were willing to provide pref equity on top of that. So not only could you borrow at 80% LTC at the starting rate of 3%, but you also got pref equity on top of it for another 5 to 10%. So you had a leverage of 85 to 90% all in. Now, these loans, in most instances, are still outstanding. Now, your borrowing cost without any rate cap is now just around 8.5 to 9%. Now, if you're lucky, you might be just around 7.5 because your spread is lower. Not everyone has taken out interest rate caps. Even the ones that took out interest rate caps tend to be in 5 to 6% range. Some of them are at 7%. So in most instances, virtually everyone has a doubling of the borrowing cost from the initial start when they borrowed. What happened to the agency side, right? We have had, again, very low treasury rates. The spreads were also pretty low. The good part with the agency loans as well as CMBS loans, the spreads actually have not gone up. They have been pretty stable. But when your treasury yield jumps up significantly, your borrowing cost still goes up significantly. So now I was talking about the bridge loan, right? Every bridge loan anticipates an exit into that you sell or that you refinance into an agency loan or another permanent loan. Now, every bridge lender underwrote to around a 4% refinancing rate back in 2021. Your best case scenario today, with all affordability benefits that you have, is around 5.5%. So you are around 1.5% above if you had to refinance that loan today of what the lender underwrote back then. What does that mean? If they provided you maximum leverage, assumed based on your NOI that you can refinance just about at the 4%, you're not able to get out of this, right? And that is what we now see with a lot of borrowers, that if they had to refinance today, that it's not a cash out anymore, it's a cash in, meaning you have to do a capital call. So what do you do when you have an existing bridge loan? What is really staggering, what we have seen during 2021 in particular, how the rent growth projections were supported not only by the lenders, but also by appraisers. This was the reason why these 80% leverage loans were achievable. And this was also a reason why a lot of pref equity providers were willing to come in with an additional 5 to 10% pref equity on top of it. Unfortunately, that rent growth is gone now. We see some markets where the rent growth is now negative or flat. And all these projections that they have made are just not coming to fruition. Now, this is really important that you closely monitor your collections, particularly when you have a C-class property, right? Everyone tends to always talk about that C-class is a great space to be in because they're always full and everyone needs to have a place to live. So in practice, that's true, right? So I think we can all agree that there is not enough affordable housing. And a C-class property technically can always be full. The problem is being full with tenants that cannot pay doesn't really help. And that's what we now see a lot in the C-class space, where a lot of these properties are actually struggling not with the occupancy, but with the collections. So watch out when you have a C-class property in particular. Now, at the same time, do not just focus on the income stream. We see a lot of issues on the expense side, where obviously everyone knows about property taxes, but now we also have significant issues on the insurance side. Some of the insurance renewals that come in are virtually double from where they were a year ago, right? It's a massive hit. Particularly when you're close to the coastline, it's really hard for you to get decent insurance in place. And if you're in Florida at the coast, good luck. Now, when you have a bridge loan, you have loan covenants. I'm surprised how many borrowers do not know their loan covenants by heart. You should read your loan covenants. You should wake up in the morning when you have a property where you are the asset manager, and you should know exactly what these loan covenants are and continuously monitor them. Because if you do not know your loan covenants, guess who knows those? The lender does, on the servicer of the lender. And the servicer is not your friend, right? So the originator may have been your friend at the lender when they originated the loan. Once it's passed on to the servicing side, they are there to ensure that you pay that loan and that you meet all the requirements of that loan, including all the covenants. So if you do not closely monitor those covenants, you may suddenly be faced with a so-called cash management trigger. You may have a lockbox that's then triggered, and you lose control over your cash management on a day-by-day basis. Maybe some of you have already experienced that. I can tell you it's an absolute nightmare to operate a property once you lose control. Now that's while you're just operating the property on an ongoing basis, right? Now, what is also important is we hear it a lot of individuals saying, well, yes, the loan comes due in a year from now, but I'm not really worried because I have a 1 year extension option, and then I have another 1 year extension option. So I'm still safe for another 2.5 years. Let's say if it's 6 months out for the renewal. What they also do not realize in a lot of instances that to extend that loan for another year, you need to meet certain requirements, i.e. covenants, to extend that loan. If you do not meet these covenants, guess what the lender does? They may call the loan, or they put in new conditions in place. They may ask for you to bring in equity, they may tighten it up, they may do a cash management trigger, whatever they want. They do not want to necessarily foreclose on you, but they will tighten the conditions if you are not meeting the extension covenants. So if you do not know those, read the loan agreement, understand what those covenants are. Yeah. Sure, absolutely. Right.
They will help you understand, or your broker, you're still friends.
Yes, absolutely, right. It's amazing how many borrowers really do not understand the loan agreement, right? And obviously it's not easy, right? It's legal language. Even for us who are in that business, we sometimes need to discuss a certain paragraph with the lawyers to really truly understand what that paragraph means, right? So legalese very often has the purpose to achieve a certain a certain item, but it's not really clear with the wording for someone who is not a lawyer. So if you are confused, talk to us. If you're still confused, and if we are also confused, talk to a lawyer about it. And again, I just cannot stress it enough. It's so important that your servicer is not your friend. You need to be on top of it. The better you are with communicating with the servicing side of a lender, the better your chances are, if you run into trouble, that they're going to help you. If you ignore certain requests, guess what? When you have to extend, they may not be then willing to really talk to you for that extension or to find some form of a modification. Now, obviously, with interest rate caps that you already have in place, if you are actually refinancing out of that bridge loan, you do not need to renew the bridge loan, and you also do not need your interest rate cap. Great. If you're in that position, you're all fine. But we know of many borrowers that are not in that position. So not only do you now need to monitor your covenants, you need to anticipate that you need to extend a bridge loan, but you also have the additional cost for the interest rate cap that you need to spend the money on. So in a worst case, you need to bring in cash to extend that bridge loan based on the conditions from the bridge lender. On top of that, you also need to bring in additional cash for the interest rate cap. So the earlier you review your finances and anticipate what's likely going to happen, the better you are with the extension. Now, I mentioned before that bridge lenders and appraisers and pref equity in 2021 in particular have been extremely aggressive with their projections or approval of projections that property buyers presented them with. That includes rent growth, that includes, but in return, the NOI. And that NOI, as I mentioned earlier, was the reason why a lot of borrowers were able to get these maximum leverage loans. And now you have a situation where not only you have higher interest rates, but you also may be faced with the reality of not being able to achieve the rent growth. You may have higher expenses, which means that your projected NOI that you had in place, you're not able to achieve. So now you have a double whammy. Not only are the interest rates higher, now your NOI is also lower, which makes it even harder for you to refinance that property. So it's really important that you understand, based on that NOI and your projection to when you have to extend a bridge loan or refinance, where that NOI in reality is going to be. And if it's not where it needs to be, you need to think what you need to do at that point, because at some point you may have to do a capital call, and it's better when you think about that now rather than when you are right there and you do not really have a choice to do the refinancing or extension. Now, with that NOI, the appraisers were also very aggressive with valuations, right? When it comes to LTV, it's important that you also understand what the likely cap rate is going to be when you refinance or sell that property. And if cap rates go up with a lower NOI, your valuation may suffer and you may not be able to get out of that bridge loan. Now, what is also important is when it comes to the SCR calculations, and this is kind of a pet peeve of mine because I see it over and over in from experienced operators. The DSCR, the underwriting that every lender does, even if you get 5 years of interest only or 3 years of interest only, that's great for you from a cash flow perspective, but the underwriting of that loan by the lender includes the amortization. And I see so many underwritings that are presented to us with, oh, our DSCR is 1.35, it's 1.5, it's not a problem. We can easily refinance. And that, unfortunately, is not the case, because you need to include the amortization in your calculations, right? So please keep that in mind. So what do you do when you buy in the current market? This is another pet peeve of mine, and I have talked about this forever. Negative leverage when you buy a stabilized property. Negative leverage is perfectly fine if you buy a true value-add property, right? There are some properties that have zero cash flow or very low cash flow. If there is true value-add opportunity, naturally your leverage is negative. It's not a problem at all. However, we have seen a lot of deals where they claim it's a value-add deal. It's fully stabilized property, 93, 95% occupied. They come in with 5,000 per unit of rehab money and call it a value-add deal. They all did bridge loans because that's the way they got the leverage, but it's not really a true value-add deal. And as long as your financing cost is significantly lower than your cap rate, going in cap rate, it's not an issue. What we now see still today are a lot of deals that are being bought with negative leverage that are stabilized properties where people are willing to overpay. So my recommendation is watch out for this and just don't do it, right? And again, I'm not against buying a value add property and have a negative leverage. That's not the issue. But buying a stabilized property at too high of a price turns you into a negative leverage situation, which is just terrible. Anticipate significant changes in market conditions from the loan application until you close. That is nothing really new, but just the last week has shown us what that means, right? You go in, you assume a certain thing, and then things fall apart very quickly. And as an example, right, agency loans, everyone is now giddy and we get a lot of calls. So the 10-year treasury is down from almost 4% to 3.5%. So it's great. Now we can borrow at the lower rate. Well, guess what? The agency loans, the spread over the treasury this week went up somewhere between, depending on the term and depending on the leverage, between 25 and 45 basis points. So yes, you have a reduction in the 10-year treasury, but you have no benefit whatsoever when it comes to your actual borrowing cost. And that is, unfortunately, the environment we are in. So you need to anticipate that. Also, right now we have 10-year treasury of 3.5%. Do not underwrite to that 10-year treasury rate and assume that once the loan closes and you can rate lock, that you're still at 3.5. Add at least 50 basis points, because these are the fluctuations we see sometimes within a week, right? So what goes up can come down, which is in your favor, but what is low can also go up very quickly. Consider lower leverage to get into a permanent fixed rate loan. Yes, 5.5% is expensive. I get that. By historical standards, it's not that expensive. It's just by more recent historical standards, it's really expensive. But it allows you to sleep because you do not have that refinancing risk for 5 years to 10 years out, right? Yes, your returns potentially will be lower, right? Particularly if you feel that you can get lower interest rates because you have a strong belief that interest rates come down over short-term interest rates over the next 1 or 2 years. Go ahead and do it. But as an alternative, if you have a fixed rate loan, your return calculations may be lower, but you may also win investors that actually prefer that they are accepting a lower return for the sake of knowing that there is no refinancing risk. Now, contingency for planned CapEx, for cost overruns. I cannot even count the deals where we helped with the financing in 2021 and 2022, where they went into cost overrun. Virtually everyone did. And that's not a problem as long as you anticipated that, right? So those borrowers are fine. Unfortunately, there are a lot of borrowers that didn't anticipate it. They didn't put in reserves in place for cost overruns. And on top of that, they didn't have enough operating reserves to cover increased borrowing costs. So guess what happens? The money needs to come somewhere. The debt service needs to take place regardless. You don't have a choice. CapEx, you may say, well, let's push that out a little bit because we need to do the debt service. So now your CapEx money is shrinking for you to service the debt, and you will never be able to service that, to do the CapEx expenditures ever. Now the lender will be on top of you because you have not done the CapEx that you said that you're going to do. So now you're also behind with that, with the lender. So You don't want to get in that situation. There are a lot of properties that are in that situation right now. It's a very unpleasant place to be in. So when you're a new buyer, avoid that at any cost. Overraise and overraise. The same applies to the operating reserves, right? You need to, particularly with C-class properties, you must anticipate lower collections. And unfortunately, it's the theme, as I mentioned earlier, out there that C-class properties are the best place to be during a recession and a downturn. For those of us who have been in this business in 2008, 9, and 10, will remember that collections were a big issue back then. Yes, a lot of people lost their homes. Yes, a lot of people moved into multifamily, but that didn't mean that they actually were able to pay, right? So hopefully this will not be a big issue, but you need to anticipate this. Do not think that just because you have a property and you have a certain collection history, that is now something that will stay the same forever. It just is not. And then again, operating expenses. During the past few years, property taxes were the biggest issue. Now we have insurance that has come on top of that, and operating costs in general, right? So yes, inflation. We all say inflation is great for multifamily. Well, on the rent side it is, but on the operating side, paying people costs money, right? So your payroll has gone up significantly, and that includes R&M, it includes contract services. Everything is passed through, right? It's not just your payroll cost, it's essentially everything in your on your expense side that has higher expenses. So keep that in mind. So it's a challenging environment, and I do not want to sound negative, right? It's just that it's important that you're prepared to do the right thing when you buy a property. I believe over the next 6 to 18 months, there will be plenty of opportunities. It will be one of the best times to buy properties when you can, but you need to put it together so that you actually can survive whatever comes once you buy that property. And if you can, you will be a winner, right? So that is really important in my view. So thanks again for hosting, Nick and team. So these are our hosts today, together with apartment educators. And on the left side there, these are my contact details. So please go ahead and scan these QR codes. And I don't know, Nick, are we open for questions or?
Thank you, sir.
Thanks everyone for coming out again. Once again, there's our contact information if you got any questions. Thanks, Anton, for doing your presentation. And let's get to what we came for, drinking and networking. Thank you again.
I'm gonna go back to your mic.
Yeah.
Okay. Hey guys, online, can you guys hear me?
Good.
Yeah. Oh, yeah, that's right. Just click it again.